Madam Secretary, I'm going to say it again, you're a lot smarter than me. But my mama didn't raise a fool, and if she did, it was one of my brothers. And what you're doing, you know it and I know it, and all those people sitting behind you know it. You're paying 5% to borrow money when you could pay 4% to borrow money. You announced you were going to do that back in November 2023. You're working cross purposes with Jay Powell.
You're not working.
And the reason you're doing this is try to give the economy a sugar high 5 months before an election. Now, you know that, and I know that.
There's nothing about issuing short-term debt that creates a sugar high for the economy.
My chairman says I'm out of time. It's good to see you.
Coming up today, Apple rips up 7%, an update on GameStop, a look at market internals, a preview of CPI tomorrow, Natty Gas lights up, Elon Musk's pay package, and a crazy prediction from me. Another day, another new all-time closing high price for the S&P 500, 53.75. Stock market holding up really firm here. Once again climbing on very low volume. That's not bearish in itself though. Just shows the market's grinding higher. We do have some soft market breadth though. We can see that in the volume breadth NYSE today. Half as much bullish volume as bearish volume. And once again, stocks hitting new lows, outpacing new highs. Volatility creeping up a little bit, but still overall pretty low. And volatility risk premium still in mid-range. We've got bond yields pulling back a little bit as we go into the big CPI report tomorrow morning. High yield bonds holding ground above the 50-day. Dollar firming up and Bitcoin pulling away from that resistance zone. Doesn't look like it wants to break out to all-time highs here. And that's a good sign of liquidity and risk sediment in the market. And we've also got crude oil holding onto its gains over the last couple of sessions. But the spread of copper versus gold still under a bit of pressure here. Same with discretionary versus staple stocks and high beta versus low volatility. So putting all that together as we're breaking out to all-time highs, not really a broad-based rally, firing off bullish signals and just performing that intermarket analysis. There's still a number of headwinds on top of the stock market here. However, just looking at the price action of the S&P 500, looks like we are holding onto this strong rally ever since we bounced off 5,200 2 Fridays ago. But stick with me today because I'll show you some more interesting market internal charts and other sectors of the market that could be looking more attractive here and some a bit more risky than others. First, let's just look at the biggest story of today, and that is none other than Apple. After the market gave a pretty good fake out and bear trap yesterday, pinging off that resistance zone as they kicked off their worldwide developers conference. Seemed the markets completely changed their tune overnight. Couple of analyst upgrades, and looks like some big institutional money's coming to Apple today. 172 million shares traded, finishing up a whopping 7.2%, which is a big move for any stock, but especially given Apple, as on average days it typically moves around 1% or so, and now looking at a 3.2 trillion market cap. And just to put that into context, that was the third largest ever single daily market cap gain for a stock after they added $215 billion worth of market cap today. However, still a ways off that record set back in February by NVDA, which added $277 billion in one day. And it's interesting that the top 5 biggest daily market cap gains have all been in the last couple of months. And so apparently Wall Street's changed their tune on Apple after initially selling off yesterday. They've had some time to process it all, go over it. And we've been hearing from analysts at Citigroup said it was the best developers conference ever, while another analyst at Goldman said the integration of GPT and a more conversational Siri assistant could help drive an upgrade cycle across its iPhone and Mac devices. JP Morgan's also on board, saying the fact that iPhone 15 Pro will be able to run the new AI features will become an important selling point for emerging markets after the iPhone 16 is released in September. And so like I'd been saying a few weeks ago, and why I didn't want to short Apple, is I thought they were going to come out and try really hard to convince the street they're on board with AI. They've got something to meet the demand from investors of wanting to know how they're going to play in on this trend. And so far, it looks like they've answered that pretty good, judging by today's price action in the stock. And so for the last couple of years, Apple has had declining sales, significantly underperformed the NASDAQ index. And maybe Dan Ives from Wedbush Securities is right. A lot of people have underestimated Apple for a while now, and they could come out and surprise us all. And who knows, maybe hit some 10-20% growth numbers over the next year or two, along with potentially growing demand for their Vision Pro headset and subsequent versions of it that are likely to get better. And I guess Apple, with their huge installed user base, over 4 billion people worldwide, I guess they are best positioned to develop and run personal AI agents, get to know us and we can conversate with. Because I'd say one day in the near future, performing mundane tasks online. For example, making a travel booking, we could just talk to our AI assistant whilst we're cooking dinner or something and ask it to find the best flights and prices to go to a certain destination at a certain time. Then we can just give it permission to go ahead, book our tickets, and then the next minute they'll be in our inbox. Whereas now we have to do things like that. Buying tickets to go to the movies, travel, hire a car. We all have to do that manually online. So there could be something here with Apple being able to integrate AI technology into their services and take smartphone to the next level, or what they're calling IntelliPhones. Either way, that's kind of required to justify the valuation now on Apple, currently sitting at an all-time high. But nonetheless, very strong price action, and it's starting to look obvious now. These fat green candles were indeed accumulation, even though Warren Buffett had been trimming his position in that time. Then they came out with a big new buyback program. The stocks just drifted right up into the worldwide conference day, and this price action bodes well for the medium term. And staying on mega cap tech, also got Microsoft pushing up against all-time highs today as well, whilst NVDA still consolidates around the new post-split price of $120 a share. So we have to get up somewhere around $128 a share for it to become the largest company in the world. And it looks like Apple's just got back out in front of it after today's move now. So Nvidia's back in the third spot. And just moving on to the other hot stock everybody's talking about, GameStop. The controversy surrounding how many times it was halted during Keith Gill's live stream, the timing of Ryan Cohen's release of earnings and stock sale announcement, burning a lot of option holders outside market hours, which I understand it's not a good look. And Ryan Cohen should come out and offer some communication and justification for his moves, even though it's considered generally normal to make these announcements outside market hours and what's generally expected of them. The guy's still all in on the stock. He's cut management, doesn't pay himself a salary, used all his own money to buy up 36.5 million shares of himself. He doesn't lend them out, and they've just surprised a little bit. Just an hour ago as I speak, come out and said they've already finished their secondary offering of 75 million shares. Did a lot better job than last time and actually raised approximately 2.137 billion. And so just to work out what average price they achieved, if we take 2,137 million, divide that by 75 million shares, 28.49. So the last secondary they did back in mid-May, the average offer price was 20.74. This one came in at 28.49. That's a pretty good job. So they announced it pre-market last Friday. They did a secondary. Stock did trade up to 68 late Thursday night, and I'd say that's a pretty good job. Bound to offload 75 million shares on the market and achieve 28.49. That's just below the 50-day VWAP of 30.30. And like I said on my Friday deep dive into GameStop, just shows the power of a cult. Roaring Kitty and his followers, because it was just a couple of months ago, were trading down at $10 a share. No way they could have come out with two secondaries. Back then, stock would have been created down to $5. Short sellers jumping on board, all of that. Roaring Kitties run the stock back up, and now GameStop has got over $4 billion on their balance sheet, free for Ryan Cohen to play with. He may come out and do an acquisition, maybe some hot new product to do with gaming or collectibles. He may start a new division. He may get into Bitcoin, try and do what MicroStrategy's been doing. He could come out with plans to shut down all stores and go completely online. The point now, they've got a strong balance sheet with a huge following, a great brand, and like I said on Friday, this could surprise a lot of people and actually turn into something long term. But of course, it's a highly volatile and still very risky stock. Anything can happen. But they got their secondary done really well. Stock finished up 22.8% today and may not come down to that support zone that I've had drawn in there. And Roaring Kitty is still holding all his shares and options with no big activity in the option chain that he's in. And that's what everyone wants to know, is what he's going to do with his 120,000 call contracts that expire next Friday. Is he going to exercise them? Is the street going to be able to deliver all those shares into his account? A meme trade is going to keep piling on, cause a huge gamma squeeze in option dealers. Because just looking at borrow fees today, looks like word got out. They got the secondary done. The borrow fee to short GameStop shares have shot up now, 14.5%, with less amount of shares available to short as well. And ever since Roaring Kitty's been back in May, we've seen a sharp increase in short sale volume in GameStop. Looks like the street, some hedge funds are starting to come back and setting up a bit of a battle again like 2021. Long meme traders versus short hedge funds. We can see the amount of shares that have been short spiking up these last few weeks. And believe it or not, getting back to similar levels from early 2021, even though there's a much lower percentage of the float short, but who really knows how many fake shares have been created and short out there. It's all such a muddy, convoluted system. But nonetheless, a very interesting and entertaining ongoing saga. So stick with Click Capital and I'll keep you all updated on how this unfolds. Just getting back to the stock market, it's easy to see why a lot of people think we're in for a big correction, especially from mega cap tech stocks, which have been on a really good run for almost 2 years now. And some saying there's going to be a renaissance coming for boring stock. The rest of the market that hasn't been doing so well, as we've had growth stocks and tech stocks, and especially semi-stock, just absolutely been on a tear for over a year now, thanks to the boom in AI kicked off by ChatGPT early last year. However, what could be next is the infrastructure that powers AI and the boom in these data centers. And that trend may have already started, but just looking at semiconductors, as a percentage of the S&P 500 index, currently at 11.6%, it's gone on an absolute tear this last decade, where it started at 2%. Maybe the next sector that could really benefit from this is utility. Not only is it one of the best stock sectors to be in through a recession or bear market because of its defensive qualities, dividend yields, and as we go into recessions and bear markets, bond yields come down, making utility yields more attractive. We've also got the huge AI boom, sharp increase in demand for electricity, and pretty good starting valuations where we currently are. Looking at the relative 12-month forward PE ratio of utilities to the S&P 500, we're actually still on the oversold side of things and below the long-term average. And there's a look at a long-term chart of the utility sector, XLU, pretty much been consolidating for the last 4.5 years. And wouldn't it surprise a lot of people if this went on to a big multi-year bull market and even managed to hold up well during the next recession or bear market? And some of my favorites like NextEra Energy, who are big into renewables, they still haven't even hit all-time highs from late 2021 either. And just stepping back and looking at the huge underperformance of value versus growth, rolling 10-year annualized return of the spread is unprecedented for its drawdown we've been in, the biggest over the last 100 years. And looking back in the long term, generally value outperforms growth. And so are we truly in a different world where we're going to maybe go into 100 years of growth outperforming value? And looking underneath the hood even deeper, at the best performing factor, small cap value in the long term is historically cheap versus the S&P 500. Again, looking at the relative difference of 12-month forward PEs, currently 2 standard deviations below average. And this hasn't been a worldwide occurrence either. In fact, value has outperformed growth for the last 15 years in emerging markets, and slightly so in Japan as well, just definitely not the case in the US. And I think it would surprise a lot of people to know that US small value stocks still outperformed large cap growth stocks over the last 25 years. And so last time growth stocks, tech stocks peaked out in the late 90s, rolled over going into the early 2000s. That caused value stocks, small cap stocks, and commodity stocks to outperform, and that lasted right into 2008. We had huge bull markets in emerging markets, commodities, small cap, value did really well, and then it all rolled over with the market in 08 going into 09. And since 09, it's pretty much been led by growth, mega cap tech. And even though we're hitting new all-time highs on the indices today, like I said, we've got some deteriorating breadth. There's the NASDAQ in the white line, and the bottom blue is the percentage of members with new 52-week highs. It's actually been creating quite a large and sharp divergence from the market. Last time we saw a bit of divergence was in late 21. The market was drifting higher, net new highs pulling back, the market rolled over. And not just on the NASDAQ, also on the NYSE, we've got deteriorating breadth and net new highs, net advancing issues, net advancing volume. At the same time, S&P 500 breaking out to a new high. The last few times we've had that, apart from 95, it signaled we're getting close to a top in 99, almost nailed the top in late 21, and here we are again firing off this signal, which means we could be getting close to a top. However, that still may not occur until next year, possibly 2026, because counteracting that is a big, large material force in the market called buyback. Steadily on the climb, with the 4-week average year over year breaking up near record highs, very supportive of the stock market when the supply of shares is going down and there's constantly money going in from everyone's pension fund. And the stock market has completely ignored the chance that we're going to get 6 rate cuts this year that was initially priced in. So maybe lucky now if we get 1 or 2. There's still the possibility we get none, and that'll be influenced again tomorrow by the release of CPI and inflation data. Jay Powell will still have to keep walking the fine line, not wanting to reignite inflation, same time wanting to grab his chance and cut rates as soon as he can. And just looking out across investment bank forecasts for tomorrow, headline CPI expected to grow 11 basis points month over month, 3.4% year over year. Core expected to come in at 0.28, 3.5 year over year. With JP Morgan laying out scenarios of how they think the S&P 500 will react. If core inflation comes in, forecast 0.3%, I think the market will be between down 75 basis points to up 75 basis points. And they're putting greater odds that it'll come in below 0.3% than above 0.35%. And they're saying if it comes in below 0.25%, the market should rip about 1.5%. And tomorrow's a bit of a rare day. We're getting CPI and a Fed decision on the same day. CPI to start the morning off 8:30 a.m. The Fed's decision at 2 p.m. with Jay Powell set to talk at 2:30. And looking back in history, when we get both a CPI and Fed decision on the same day, most of the time, especially looking at the Nasdaq, 84% of the time, we finish higher with the average gain around 1%. So pretty bullish seasonality heading into tomorrow, especially if we hear Jay Powell come out with a more dovish tone, like Elizabeth Warren wants him to, actually writing him a letter urging him to cut the federal funds rate from 5.5%, saying the sustained period of high interest rates is already slowing the economy and failing to address the remaining key drivers of inflation. She also mentioned the ECB has gone ahead and cut interest rates and that it's time for the Fed to do the same. So I'm sure Jay Powell loves getting a letter from Elizabeth Warren telling him how to do his job, but it appears all levels of government now really want lower rate in the States. And who knows, she may be right. Just looking at government jobs as a percentage of total job opening, been on an uptrend for the last 2 years now. That's typically what happens going into slowdowns in the economy and recessions, because businesses will pull back their hiring like we're starting to see signs of. And so naturally government jobs will become a larger percentage, and governments can also try and stimulate slowing economies by offering more jobs of their own. But what happens to inflation if some key commodities keep ripping? Luckily, we've got oil pulling back hard. We've got natural gas marching higher again now. On the back of forecasts for extreme heat from the National Weather Service, showed hotter than seasonal temperatures in store for most of the US east of the Rockies over the next 6 to 14 days, while the Southwest and California continue to deal with high temperatures this week, with one commodity analyst saying above average temperatures are forecasted for the entire country in the 10 to 20 day outlook, likely increasing demand for cooling. And so that's got natural gas futures moving up pretty strongly there today, now in a clear uptrend. We've got crude still holding ground around $78 a barrel, gold just kind of consolidating after its big fall on Friday, and overall the commodity complex still having a bit of a pullback here. And I guess for the federal government, they must be really hoping that history doesn't repeat, looking at CPI inflation from 1967 to 1985, overlaying that with CPI from 2014 to where we are now in 2024, kind of eerily similar pattern. And what's interesting is back then in 76, the Fed started cutting rates too, because they thought inflation was done, only to add fuel to a second and even higher wave of inflation going into the late 70s. And so whilst oil pulling back is good, some signs of softness in the economy, hopefully we don't go into a stagflation scenario, no economic growth while still persistently high inflation. Because just looking at this chart here of freight rates pushed forward 5 months and PCE inflation in the States in the blue, again, eerily similar correlation, suggesting that inflation is about to turn up again thanks to an increase in shipping rates, which finds its way into a lot of our goods and services pricing. And with the US government printing dollars at record levels, over a quarter of all dollars in circulation created over the last 4 years, what happens to the price of commodities that are priced and traded in US dollars if the US dollar goes the way of the yen, who also with a lot of debt have devalued their currency to try and inflate away their debt? What happens to the price of commodities over the next 5-10 years if the US dollar loses a significant amount of value? That could add even more upside pressure to commodities and inflation. But for now, looking at the dollar, it's holding up okay. That's more of a long-term trend that many are observing. The US dollar international reserve isn't going away anytime soon either. Just moving on to Tesla and the controversial pay package for Elon Musk. And I've got to say, after Donald Trump, he's probably the second most controversial person I speak about on this show. Always get some interesting comment anytime I cover these two. And in my opinion, the deep state has done a good job at trying to turn a lot of the masses against those two, since they don't really work according to their agenda. You know, more war, more censorship, things like that. Anyway, I digress. That's just my opinion. Back onto the pay package with Elon Musk. There's a vote on whether to award Musk the controversial $56 billion package this coming Thursday, after previously court in Delaware reversed it, and he moved the company headquarters to Texas after that. The court argued he didn't deserve it, even though he met the market cap and financial hurdles and benchmarks that the board was too friendly with them, and it's an outrageous pay. And there has been some big key institutional investors come out against it, like Norway's sovereign wealth fund, which owns a lot of the stock. Elon has claimed roughly 90% of retail investors are in favor for it. As a Tesla shareholder myself, I'm in favor of it because it's about honoring the deal. The board laid out clear terms for which he would be rewarded this compensation and stock. If he met them, which he did, made a lot of people a lot of money. And at the end of the day, he's the visionary and guy that works all day, every day to turn this company into what it is. And it's not about his own personal wealth. He's not looking to buy a mega yacht like Jeff Bezos, or donate $400 million to the Democrat Party like Mark Zuckerberg. He's not looking to drip himself out with gold, lavish items and that. He just wants voting control of the company. So what happened to Steve Jobs and Apple in the 80s doesn't happen to him as well. He wants to have a hand and say in the future direction of the company and not allow others to have leverage over him, which again, as a shareholder, I agree with. I know a lot of you don't like Elon Musk for whatever reason. That's fine. We don't have to agree on everything. I'm just sharing my opinion and how I feel about it, and just honoring the contract and the spirit of the contract. That being said, I realize it's a huge number. However, he did take Tesla to $1 trillion market cap, which allowed them to raise almost $30 billion in capital over the last 5 years, really strengthened their balance sheet, put them in a strong position to expand production, invest in new gigafactories, shut down the short sellers, and I understand a lot of them still feel very burnt and constantly point out any potential technical wrongdoings Elon's done, as if he's supposed to have some perfect track record like nobody does. Again, that's just all my opinion. Feel free to drop your comments, tell me why I'm wrong, but we'll see how this all unfolds, because what they did in the Delaware court could lay precedent for a lot of other companies as well, if they can just go back and reverse deals that were agreed on, approved by shareholders, and made a lot of shareholders happy. Then I don't know, it kind of just questions the whole system and capitalism if someone's going to get really punished for creating one of the world's biggest companies. And if you thought my take on Elon Musk was a little controversial, well, wait till I get into Hunter Biden. And I'm not trying to get too political on this channel. You all know that I'm following the American federal election closely. Not only is it one of the most entertaining things, it also has big knock-on effects to financial markets and all of us really. And so I've got a bit of a wild prediction that I'm about to make to you. And I'm not saying it's going to happen, just saying something that could happen. And I'll give you my reasons why. So we just heard Hunter Biden convicted in a gun case, which is just one of his proven crimes that he's been convicted for. And some of the media saying it's just a sideshow and distraction from the Biden family scandal. And again, which it's been proven they've set up a web of companies and taken over $40 million from corrupt overseas officials. And since we're hearing from many insiders that behind closed doors, Biden is showing signs of slipping. And that's not all his own fault. I mean, he is an 81-year-old man. Some saying being president is like running a sprint and a marathon at the same time. It's very physically and mentally demanding. Most 81-year-old men are not really up for the job, and anyone with 2 eyes and 2 ears that's watched him speak lately will see that he struggles quite a bit just to string 2 or 3 sentences together. And so a lot of people, myself included, would be really surprised if he could pull off another 4 years in office, physically and mentally. And Trump looking like he's already a lock-in to take the election, based on the odds and probabilities we're getting from sports books all around the world. My crazy prediction is, now that his son Hunter has been convicted, he'll come out and pardon him and make an announcement to the American public and the world that he did what's right as a father for his family, but he realizes because of that he can no longer stay in the race, which is really a disguised way of saying he's physically not up for it. His inner circle don't support him for another 4 years, and instead we'll see Gavin Newsom as his replacement to take on Trump, because Michelle Obama herself and her office said she's not going to enter the race. Nor do I think she wants to go toe-to-toe to Trump either. And I can see Robert Kennedy getting a lot more support if that were to happen. And in my opinion, I don't think half the country would vote for Kamala Harris as well. So it's a crazy prediction, I know. Sure, I'm going to ruffle a few feathers by saying that, but just let me know in the comment. What do you think about this? And then if true, we'd have to start looking at Gavin Newsom and what sort of policies he's likely to enforce and how that could ripple through and affect global financial markets as well. Because just to be honest, guys, I'd be very surprised if Biden can pull off another full 4 years. And apparently people close to him are starting to ask the same thing. So anyway, let me know what you think and what's your prediction for this federal election. And I'd also be interested to hear if there's anyone watching this video that actually supports Biden in another 4 years. And I know there's a lot of people out there that'll just vote for them because they hate Trump, but I'm interested to hear from anyone who thinks Joe Biden physically and mentally is up for another 4 years with leading the United States of America. You're welcome to drop your comment below as well. Okay, moving on to the economic calendar. Inflation data due out shortly after I speak from China. Going into tomorrow, there's the headline number that's expected for inflation rate month over month, year over year, 3.4. Then the Fed interest rate decision, and we'll hear from Jay Powell a bit later on. Going into tomorrow, we've got Fed fund futures still pricing in that cut to come in November. That may change a lot tomorrow. Fear and Grid Index still in the neutral zone, and corporate insiders not doing too much more selling than buying. Best performing sector today was technology, thanks to Apple, with airline jets the worst performing sector, and Apple helping to break the Vanguard Growth ETF out to new all-time highs. There's cannabis still consolidating in the support zone, so it's getting ready to break either way here, up or down, which is still yet to be seen. We don't have a huge divergence on the DSI. We'll keep an eye on that. There's a look at the price of Tesla, losing its 50-day VWAP, and a lot of the large financials still pretty soft and weak here, with some of them coming off hard today. JP Morgan losing its 50-day, down 2.6%. So like I said, we've got a bit of a divergence and weak market breadth. See that the Russell 2000 underneath the 50-day, the VIX back above its 20-day, industrials and financials underneath their 50-day, and the dollar strong across the board. It's really just the mega cap tech holding up the main indices, along with the growth first value, momentum, quality, and growth. So that's the tail of the tape. Still this skinny rally holding up the index, but I think that weak market breadth could keep some overhead pressure on it. But breaking out to all-time highs is not exactly the most bearish price action. Typically, the market doesn't crash from making highs. It's already got to be soft for it to really roll over. And with the VIX below 13, high-yield bonds still holding up, the market's really not too worried about anything bad happening anytime soon. We'll see what happens tomorrow with CPI and hearing from the Fed, along with the price action in Apple, ongoing saga of GameStop, and everything else happening across financial markets. Thanks very much for tuning in and listening to my analysis and opinion. Hope I didn't offend too many people, and I look forward to making another video tomorrow night. Cheers.